The housing market never stops moving, and this week, the headlines are packed with stories every real estate investor needs to know. I'm Dave Meyer, and I'm joined today by our expert panel, Kathy Fettke, Henry Washington, and James Daynard. And in this episode, we're covering major developments from hedge fund activity to the evolving difference in rental and housing affordability to the markets with the biggest price cuts. So whether you're waiting on the sidelines or actively making offers, these are the stories shaping the market right now. Welcome to On the Market. Let's dive in. Henry, James, Kathy, good to see you. Thank you all for being here.
Good to see you.
What's up, buddy?
Henry, I'm going to pick on you first. Tell us your story. Tell us all your stories.
The danger of golf, for example.
Yeah, I did. I did have a dangerous golf outing today. I have a very swollen hand and wrist from taking a dive out of a golf cart that was careening towards a cliff.
This just sounds like an action movie.
I assure you, it was as graceful as Jason Statham diving out of a moving vehicle.
Yes, exactly. All right, now you told us a story. Tell us your real estate story. What headline are you bringing to us today?
Yeah, so I picked an article from the Wall Street Journal, and this article is titled, New Real Estate Fund Hauls in Billions to Buy Distressed Properties.
Ooh.
So just when you thought hedge funds were out of the business, they are now back. Brookfield Asset Management has recently raised $5.9 billion in the first quarter of 2025, and they are going to use this to buy distressed real estate. That brings their total to $16 billion, and this is the largest in their firm's history. What they are looking to do is make strategic acquisitions. They are focusing on acquiring assets like apartment buildings and warehouses that are priced at 20 to 40% below their peak values, and they are positioning to capitalize on falling prices due to uncertainty in the market, specifically in the commercial and multifamily real estate spaces. So in other words, they're going to plan to buy up assets at a discount, and they are hoping to capitalize on opportunities that tariffs bring into the picture. So they're basically saying that due to the implications of higher construction costs due to tariffs, they are banking that existing properties that aren't being constructed from the ground up are going to go up in value. So they're trying to gobble up some of those assets now.
I like that
in hopes
theory.
that the values of the existing assets go up.
I'm so glad you brought this article to us because so often people are reading the headlines and thinking that as an investor, it applies to them. And it does in the sense that you should do everything opposite because it doesn't apply to you. It's home buyers that generally those articles are talking about. Even when this article says real estate, they're not talking single family homes here. They're talking commercial real estate that is on sale. But, you know, investors need to look at headlines and read it from an investor perspective, which, again, is usually the opposite. And when you see big hedge funds coming in at a time like this, it's really a good sign. You know, this is the time of opportunity.
Yeah, I agree. I think a lot of times when you see these institutional funds, it can signal a bottom for the market. It's not always that case, but like if you think about what happened in 2011, 12, like that's when a lot of hedge funds, institutional investors started buying residential real estate, and that helped set the bottom for a market that had been falling for 3, 4, 5 years. And in commercial, you know, there's no saying it would be the same, but like that market's been falling for 3 years now. And so having this level of volume and money coming into it could be a good sign for setting the bottom and reversing trends. You know, how much are they raising to Henry here? $16 billion, it says.
$6 billion pocket change for them, but
yeah, like it's not enough to set a bottom. But if this is one fund, you know, if this is sort of evidence of other activity in the market, like that could help start things to grow again.
I was just talking to someone from San Francisco and I said, how bad are things there? And he said, well, you know, you can get a condo in San Francisco for 2014 prices.
Wow.
So you have to look at that. Okay, so it's still really expensive even in 2014, but it's almost like reversing the clock 10 years. It's just, again, it's a buyer's market. That means it's time to buy. Prices are down, inventory's up. Prices aren't down a lot, but like in some places, 2014 values, if you love San Francisco, this would be the time to jump in.
It's funny you say that because one of their acquisitions in this fund was or is a portfolio of troubled San Francisco apartment loans.
Oh, that's so
interesting.
funny. Yeah. And then condos in Florida are on sale too. So doesn't sound like they're interested in that, but our audience might be.
Did they already acquire this or they just raised it? Because sometimes I feel like these hedge funds are like, oh, wouldn't this be a good thing? Like if we can buy this stuff for pennies on the dollar, let's just get it ready to go. Because like I feel like this was already said 18 months ago when rates shot up. And I didn't see them going on a buying spree either. Like, I mean, if you look at right now, distressed real estate and commercial in the third quarter of 2024 was $102 billion. And that's not a small amount. My always question is, how are they forecasting this? Because I would think the tariffs would cause less problems than the interest rates that we saw the hike on. Mm-hmm. And so like, why tariffs versus the interest rates? Or is that just the breaking point between the cost of money and the cost to build?
To me, it just sounds like they're doing what we do, but on a grander scale. They're making sure that they're buying at a deep discount. So they're not just going out and acquiring assets. I think a lot of the single family hedge fund buyers, back when that got real popular, they were paying pretty close to retail for these assets in hopes that they could rent them out and then appreciation go up. But in this fund specifically, it looks like they're buying at a pretty deep discount. And then they're hoping that the assets that they buy go up in value because new construction will be not as popular because of the tariffs. So it sounds like they're banking on buying at a discount. And if it doesn't pan out like they hope, at least they bought at a discount.
But I still don't understand why they think this is the tipping point.
You don't think so?
Like, I believe there's a blend, but I also believe that rates are going to come down as costs start to rise. That's truly what I do believe. Like, I think rates could come down, which would actually help. And one thing we've also seen is flat rent growth. And so if rates do come down and rents go up, the construction costs are going to be a blip in the bucket. And also, a lot of this stuff has already been built. I know in Washington alone, our permits for multifamily, there's like none coming out right now. So no one's starting ground. So the tariffs are irrelevant at this point.
Well, isn't that kind of the idea? Like no one's breaking grounds and costs are going to go up. So they are trying to get in on that. I guess like if you think rates are going to come down that much, that could happen. But if costs are going up and inflation goes up, like rates might not come down. Maybe that's what they're betting on.
Yeah. I don't see anyone saying that rates are going to come down. But I would say from a, hedge fund perspective, billion-dollar funds, they're looking at buying quality assets that are cheaper than they were and that historically go up in value. And, San Francisco is one of those places that historically goes up in value. So if you can ever find that window where there's a discount, they know to jump in on that. The only thing that would stop that is if there was a massive earthquake. But you know what? We've had those and
Could be.
we overcome. So it just seems like they know pricing, what it is now, compared to what it used to be, what kind of cash flow it would bring in today. And I don't know, James, I think that they've been pretty active, maybe not as visibly because I think a lot of the hedge funds may have been coming in as rescue money, private equity coming in to save some of these projects and taking a higher priority. I think they've been active, with so many loans that have come due, so many commercial loans.
Yeah, this article does say that they've deployed about a quarter of the fund that they've raised so far. So not a ton, but they're moving some of it.
We will see. I don't know why. I felt like this was the talk 18 months ago. And then maybe it's just my disappointment. I thought I was going to see some better deals on multifamily. And I just, you know what? I didn't see them.
Yeah, I know.
Like there was some needles in the haystack, but that's about it.
Not much.
Did you hear Brian Burke? Brian Burke commercial. His little rhyme is dive in 25, fix in 26, heaven in 27.
Yeah.
I think that's what he said last time I talked to him. So he thinks, it's going to go down more this year. And then the buying opportunity comes towards the end of this year into next year. And 28 is too late. That was the last thing he said. So I don't know. He knows way more about commercial multifamily than I do, but that's what he's predicting at least. All right, let's move on to our second story here today. Kathy, what do you got for us?
Well, this is an article from Mortgage Technology, and it's entitled May 2025 Mortgage Monitor. ICE Mortgage Monitor, first-time homebuyers comprise record share of agency purchase lending in Q1.
Really?
So it's crazy. And then it goes on to say, this is a quote from Andy Walden, head of mortgage and housing market research at ICE. ICE is not maybe what you think it is.
Different ICE.
Bad timing for the choice of this name. But anyway, it's Intercontinental Exchange. Inc., and it's the mortgage market. So this Andy Walden said younger home buyers are picking up market share with lenders this spring, with people aged 35 and under accounting for more than half of financed home purchases by first-time buyers in Q1. So that's so shocking. People under 35 are making up half.
That's crazy.
What is it? Did it say what it was recently? Because I feel like the narrative is like young folks, first-time home buyers can't buy homes right now.
Well, then it goes on to say first-time home buyers are driving a record share. Now, this is not just people under 35, but just first-time home buyers are making up 58%. This is pretty high historically. As far as I can remember, I don't have the data of what it used to be. And then Gen Z accounts for 1 in 4 loans issued to first-time home buyers.
Wow.
And the oldest of them is 28. So, man, look at them go.
Wow. Interesting. I feel like millennials and Gen Z have gotten so used to low affordability that like just the fact that things didn't get worse last year is relatively good. And maybe they're starting to jump in right now.
Well, and I think they're probably not buying in that condo in San Francisco that may be discounted, but not enough. They're probably buying in more affordable places to make the numbers work. And, you know, quite honestly, if we're looking at $200,000, $300,000 homes, the mortgage payment isn't that different at 7% and maybe not that different from rent. Although I think one of you has an article on the difference between renting and owning. I'm sure it's still more expensive to own, but you know, they're jumping in and good for them.
Yeah, absolutely. That is encouraging. I mean, I think we're in a softer market right now, which means maybe they won't realize the appreciation right away, but it does mean in a lot of markets, at least, there's better deals to buy. And this is like an opportunity for people who have been waiting to potentially try and negotiate and find something that they actually can afford while there's properties sitting on the market longer, there's more inventory. I think it's encouraging.
Absolutely.
I mean, well, if you look at this disparity between first-time home buyers' average down payments and repeat buyers' average down payments, that's crazy. First-time home buyers' average down payments $50,000, repeat buyers $134,000.
Wow.
But the question is, how much did that repeat buyer make in equity? Right. And does it matter? Because typically they're rolling it over and they're doing pretty well if they owned in the last couple of years.
That's a really good point. Yeah.
I will say that where we are seeing a lot of movement in what I understand when I'm talking to like flippers and developers across the nation is especially flippers that are there's a lot of traction in those USDA first-time home buyer loan markets because they're putting less down. And that's why there's a lot of people buying right now because they can still buy in affordable areas and the cost of rent versus purchasing is not that different. And then there's good products for these first-time home buyers. And that's why there's some movement in that market.
All right. Well, I love the optimistic story. Thank you so much for bringing it to us, Kathy. I'm going to pick on another buzzword of the week or the month or the year, whatever it is, price cuts. You've probably heard a lot about this, that there are price cuts going on in a lot of markets, and it really depends on the individual market. And I have the top 10 markets for price cuts right in front of me. I'm going to read them to you, and I want to discuss what you think this means. But does anyone have a guess? Number one, Henry?
It's probably somewhere in Florida.
Wrong.
James?
I'm thinking, because I'm living in it, I'm watching it, Scottsdale, Phoenix, I've been seeing a lot of price cuts in.
Did you read the article?
No, literally, I've been watching this. But
yeah.
I mean, the interesting thing to do, because I started watching this, and I'm like, wow, things are coming down quickly. That's something you want to look at. The interesting part about that, though, is that the price cuts, like the homes are already priced 15% higher than they should be already, right?
They're just overpriced, and they're getting back to where they should be.
I was watching this one neighborhood, and Henry, don't give me grief because the number I'm going to pull out right now, but like the homes sell for $1,000 a foot in this neighborhood.
That's insane.
A lot of these homes are listed at $1,200 a foot and $1,300 a foot, and they're cutting off that. So it's like, also don't be alarmed if there's price cuts, if it's still staying above what it was last year.
Right. What James said is the important part before I share this list is that price cuts don't always mean price decline.
Yes.
What it means, it's a measurement of how well the property is priced, not a measurement of how aggregate property values are trending. Now, sometimes, and honestly, often those two things go together, but that doesn't necessarily mean they are. And I think we've talked about it on the show for years now that there's just some sellers who haven't caught up with the times and are asking for the moon, and they're going to have price cuts. And there are some people who price it appropriately to move their properties, and those probably won't. So just keep that in mind. All right. Well, now, with no further ado, the top 10 markets for price cuts. 10 is Salt Lake City, which I was surprised by. That's a very strong real estate investing market. 9 is San Antonio. Tied for 7th and 8th is Orlando and Dallas. So, Henry, you were definitely on the right track with the Florida and Texas here. 6th and 5th were tied, Denver and Nashville. 4th, Raleigh, North Carolina. 3rd, Jacksonville. 2nd, Tampa. So a lot of Florida, and then 1 was Arizona. But I think the thing that really stood out to me here was like, these are good investing markets. Like you talk about these markets, it's, Raleigh, Salt Lake City, Nashville, Dallas. These are all markets that people have been clamoring to get into for years. And so curious what you guys make of this. Like, James, you invest in Phoenix. Like, does this scare you out of the market? Does it make you more excited to invest there? How do you interpret it?
I actually get more excited when people read one headline and then they run with it, right? You have to, as an investor, you have to dig into it, right? And so like, as I'm learning Phoenix and learning Scottsdale, I'm going, okay, well, I'm seeing price cuts. Do I want to avoid this neighborhood or not? But then I go back and go, well, the data says that they're already priced 20% higher price per square foot than they were the year before. And so it's all a perception thing. And you always got to take that next step and, okay, is that market reclining? Now, do I think Phoenix is going to have issues? Yeah, there's a lot of expensive stuff for sale, and if people don't price their homes correctly, they're going to go down. But I've also seen some very healthy parts of Phoenix where I'm excited about buying because things are selling. They're selling at full price, and you really just have to break down the segment. And as I'm learning to invest in Phoenix, that's what I'm doing. What pockets are in the affordability spots, and focus on that. Because if people are freaked out, but you can identify the good pockets, that's where you want to invest.
And like, if you're watching your market like James does, and like I watch my market, this is kind of good news for me. Because if I'm going to list a property like a flip for sale, I'm going to look at all those comps. Hopefully they are on the market overpriced. I'm going to make sure that I remodel my property to look better than theirs. And then I'm going to list it below theirs because I want to capture all the eyeballs that are going to go look at those properties. Now they're going to come see mine, and hopefully they'll make a bid on mine before they make a bid on theirs if I look better and I'm priced lower. Like, it forces you to be more strategic.
And I think from a buyer's perspective too, like, sellers have a healthy fear of the market now. I think for years they were sort of acting with impunity. It's like, why not just throw another 50 grand onto the asking price? Because for a while you were getting it.
You were getting it, yeah.
But now seeing that poorly priced inventory is not selling, I think is a good thing for everyone. It sort of causes a reality check in a way where people are going to have to be more honest and thoughtful about what the true value of a property is. And to me, that just helps the whole housing market become healthier, hopefully over the next couple of years. And I know people don't see that, but we've talked about on the show, I do think we're trending slowly in that direction.
And you just need to know your strategy. If you're trying to flip properties, look at Denver. Inventory has increased year over year 45%. So you better price it right. But if you are a buy and hold investor, if you're a rental property investor, you're probably not selling. You probably care more about if rents are going down or up, if there's more demand for what you have. And if everything's going well, then this is your opportunity to increase your portfolio, to buy in areas that maybe just didn't make sense before, but they might now, because why not make a ridiculous lowball offer in an area that has 45% increase in inventory? Who cares if it upsets them? Just do it. You never know.
Right.
So I like the word justified offer rather than lowball.
Okay, that's better. Yeah. I got food thrown at me once for giving too low of an offer.
I think you're right, though, Kathy. Like, I haven't been investing in Denver, and I haven't in a few years, but I've been looking at deals the last couple of weeks, and they look better and better. And you're seeing people price more appropriately, seeing things sit on the market longer, and it's becoming attractive again, because I personally believe in the long-term upside of Denver. I've lived there. I understand it. I know it. They've had an oversupply issue for sure.
Yes.
Absolutely. But, those things get worked out. It's the same thing, I think, in a lot of these other markets here. These are places where people want to live. And you have to think the reason why they're oversupplied is because builders were feeling good. They were looking at the data and saying, hey, a lot of people are moving here. And that can create short-term weird dynamics between supply and demand, but they're following long-term demand trends. And so I'm not saying to go out and buy everything. There's going to be a lot of junk, as there has been. But to me, seem to present an opportunity, if you're disciplined about it, that these are really good markets where you're going to have more motivated sellers for the first time in 10 years. I don't know, like a long time. And so that might be an opportunity for people to consider.
Yeah, especially Denver, because it seemed like a pretty investor heavy city with a lot of people learning how to flip. And, they might have put a lot of money in a property and found out they cannot sell it for what they thought. They just might need to get out of that hard money loan. So
call me.
Yeah.
Call me.
Yeah, and it's also another good argument for why you need a good, seasoned, experienced real estate agent. Because an inexperienced agent might just run the comps and say, all right, let's throw this thing on the market for this price point. But an experienced agent will understand the neighborhood, understand if homes in that neighborhood are overpriced, and understand how to get you the most eyeballs and looks on your property.
Yeah, that's a great point.
Or understand how to help you negotiate making a justified offer on an existing property.
All right. So far, we've talked about hedge funds back to their old wily ways, how younger folks are getting into the housing market, how there are a lot of price cuts in great cities with good long-term fundamentals. James, what's the story you're bringing us?
All right, I'm bringing, it was an article published on bankrate.com, and it's renting is increasingly more affordable than buying in most large U.S. metro cities. I actually thought this article was very, very informative as far as investment strategy goes. And what it talks about in the West Coast, the most expensive cities, right, where it's actually dramatically more expensive to own than rent, that trend is continuing. And so it is 190% more expensive to own than to rent in San Francisco.
Wow.
In San Jose, 185, Seattle, 119, Denver, 96, Salt Lake City is 90. And I think that's also why we're seeing some adjustments like what you're talking about in Denver. In 2024, it was 78%. And in 2025, it jumped up to 96.5%.
Wow.
And that's a huge difference.
So that means rents went down, right? Because prices in Denver have been sort of flat. So it didn't get more expensive to own a home. So it must have gotten cheaper to rent.
Yeah, and 2024, I think from what I understand from people in Denver, it kind of started really falling off the tail end of 24. So that might change a little bit. But this is really good information as you're investing in a city for predictability. And, what do you want to do? What do you want to invest in? And is it the right strategy? What that tells me is people that want to house hack in San Francisco, Seattle, not the greatest play.
No.
You can rent and go buy something or invest elsewhere and do better by your savings. But then other major metro cities that are more affordable, if you look at Detroit, it's 2.3%. And in 2024, it was only 2%. And so there's been a widening gap. And so the reason I felt this was interesting is I do think San Francisco, Seattle, San Jose, they're proving they're pretty strong markets with buyers, because if they jumped up 10%, the buyer pool is still pretty healthy because they could weather that storm to buy. But it also tells me that I do believe part of this is because rents are flat. If you look at Seattle, rents were really flat 2023 into 2024, and we're starting to see a jump in rents in this quarter right now. And so as we look at buying, if we see that big gap, even though rates are high right now, if you can go buy a good rental, you might see some serious rent growth, or vice versa. You might see single family housing coming down. One of the two are going to break.
Yep.
And so there's either going to be rent growth or housing price cut. It's a big deal. And as we forecast into uncertain times, and to look at each city, not every state, every city's the same, and that's where you really have to break it down. I know in Detroit, I'd be house hacking like crazy, right? It's that makes all the sense in the world.
This is one of the major changes over the last few years that, for a while, it was sort of a no-brainer to house hack anywhere, but now, I don't know, if you lived in Seattle and San Francisco, you might be better renting and investing in the Midwest, investing in the Southeast. It's
I don't know.
I don't think that's that bad. It's a decent idea.
House hacking is how I got started in the San Francisco Bay Area.
You house hack now.
And I do still house hack in a very expensive market. So I kind of disagree. I feel like expensive markets are the market to house hack. But the thing is, you have to be able somehow to do it. And like I said, you've got to see, you can still get a loan as a first-time home buyer with 3% down FHA. And in the San Francisco Bay Area, because it's expensive, you can get a pretty high loan. And you can, I think it was 1.3 million for a fourplex. So that's how we did it. We bought a really big house and we kind of turned it into a fourplex, and we were able to live in the nicest part of the house. We partitioned everything off so that there was no sharing of kitchens or bathrooms or anything, but we were kind of able to live in the nicest part of the house in a great school district for our kids for almost nothing.
Yeah,
because we rented out the other 3 units. So I'm a huge fan of house hacking in expensive markets.
That totally makes sense to me, Kathy. It's how I started too. But when you look at it, like the amount of money you would have to put down, you could often earn a higher return if you were just to invest in the Southwest or, Southeast or something and buy like a cheaper property. You have to actually go do that. But I do think it's a good option. And what I'm personally learning and doing is like in these expensive markets, rather than house hack, James knows this because he helped me buy it, but a live and flip is, I think, a more desirable owner-occupied strategy because you're not dependent on that rent, but the upside and appreciation and value is there. And so it's two sides of the same coin of owner-occupied strategy, but I did the math, and the math to me in an expensive market says do a live and flip over a house hack. Now, you need to have more capital to do that because you can't just put 3.5% down, but it is something to consider.
That's what I was going to say is it just depends on how much money you have and if you can qualify. If you could qualify for $1 million mortgage with, just 3% down with, being able to count the rental income, good for you. But if you can't, then by all means, go buy an investment property in the Midwest instead.
All right. Well, James, thank you so much for bringing this story as well. Any other stories you want to tell us?
We got some more zombie houses coming up soon.
Oh, so yeah. Congrats. James' show got renewed for a second season, $1 Million Zombie Flip.
And there's so many dirty houses we get to go look at. It's like my favorite thing in life is to want to throw away my shoes after I walk out of a house. I'm ready.
All right. Well, thank you all for bringing these stories. Really appreciate it. James, Henry, Kathy, we'll see you very soon. And thank you all so much for listening to this episode of On the Market. Before we go, make sure to follow On the Market wherever you get your podcasts and subscribe to our YouTube channel where we share all sorts of exclusive content and analysis. We also have a new weekly newsletter just for On the Market where our analyst, Austin Wolf, keeps you updated and informed on everything happening with specific market data. Again, I'm Dave Meyer. Thank you all so much for listening. We'll see you next time.